Okay, we're going to get started. Hello, everyone. My name is Josh Levine. I'm one of the partners and senior financial life advisors with Telemus. Just want to thank all of you for tuning into the webinar this afternoon. Today, we're going to be discussing a pretty unique investment strategy utilizing life insurance in qualified retirement plans. And this is really to minimize overall tax exposure and maximize after-tax wealth when taking distributions. So throughout the webinar, some of the things that we're going to review will include how to estimate the true value of qualified plans, taking into account cap gains, income, and estate taxes, what steps should be taken now, considering today's historically low tax environment, and then really which types of qualified plans actually allow this strategy. Now, one important thing to note is that the strategies discussed today are not necessarily appropriate for everyone, and each individual's situation is going to be different. So make sure that upon considering the information that we discuss, definitely consult your retirement plan administrator as well as your trusted tax advisor and estate planning advisor to determine the suitability for you. We also encourage everyone really to think about questions to ask as we go through the presentation. Because there are some sophisticated strategies that we're talking about, and it can get complicated. If you do want to ask questions, make sure that you either submit them in the question box to the right or raise your hand on the control panel, and we will call on you. So with that, I want to introduce our featured presenter, Mr. Michael Fontanini. Michael's Vice President of Advanced Sales and Design with Lion Street. Lion Street's actually a national network of independent life insurance advisors, and Michael he specializes in helping Lion Street firms develop sophisticated life insurance solutions that meet sophisticated needs of high net worth individual and business owner clients. Michael's a CFP and a chartered life underwriter, and he's also pursuing a master's in taxation at Villanova School of Law and Business, and he currently resides in Austin, Texas. So with that, Michael, I will turn it over to you.
Very good. Thank you very much for that warm introduction, and thanks again to everyone on the phone today for spending a few minutes with us to learn about a very powerful and effective strategy, as mentioned, for the right type of client. So what I'd like to do to start off with is talk about what is the primary challenge that this strategy seeks to address. Whether or not they realize it, many individual investors have a very big either current or future tax challenge to address within their overall financial and retirement planning. And that really focuses on the taxation of money that has been accumulated inside of a qualified tax-deferred account. So let's first start by talking about that just a little bit and really highlight that challenge, and then we'll move on to the solution on how it can be addressed using the qualified leverage strategy. So there's various types of accounts in which individuals can invest money or save money for growing wealth to accomplish their future financial planning goals. There's the taxable account, taxable type of account, tax-deferred account, and the tax-free account. So the taxable types of accounts are typically those that are funded with money that has already been taxed, your kind of traditional after-tax dollars, if you will, or more technically speaking, your non-qualified dollars that have already been subject to taxation. And the types of investments that can fall under this category are those that you're probably pretty familiar with and probably are already either investing in yourselves or managing on behalf of your clients. And those are your stocks, bonds, mutual funds, cash, et cetera, et cetera. And the taxation of those types of assets are obviously subject to capital gains taxes on any realized gains that are either long-term or short-term in nature, as well as any dividends and or fixed income that is realized as well. And obviously the tax treatment of any short-term gains or fixed income type growth is subject to ordinary income taxation. Then you have your tax-deferred accounts. Those are going to be either funded on a pre-tax basis, meaning money goes into the account before being subject to taxation, kind of like voluntary contributions to a 401k or employer contributions to a profit sharing or pension plan. And then you also have money that can be invested in a tax-deferred environment that has already been subject to tax, and that's your non-qualified after-tax funded type of an account, which would be something like an annuity or maybe a traditional IRA that has been funded with money, after-tax money, basically. And then the tax treatment of any distributions from those types of accounts is 100% ordinary income to the extent of gain in the account, plus a 10% penalty if taken under age 59 and a half for most practical purposes. And there's some exceptions to that rule, which are beyond the scope of today's conversation. But generally speaking, you have to wait until a certain age in order to take money out of that account without penalty. And then lastly is your tax-free type of account. And that's primarily for high income and high net worth individuals. Is going to be your Roth 401k type accounts if the individual has access to one through their employer or through the company that they own, depending on their situation. And then also a properly structured cash value life insurance can be a very effective after-tax, tax-deferred, tax-free type of asset for high-income folks, especially for those that are beyond the income qualification limits for your traditional tax advantage vehicles, or maybe are already maximizing their contributions to those types of vehicles. And we're going to talk a little bit more about that here in a few moments. But what we're going to focus on first really is that tax-deferred account right there in the middle. And specifically the pre-tax qualified bucket. That's the primary type of account for which this strategy is a very effective solution. So most individuals that have money in those qualified tax-deferred accounts, like a 401k, pension, or profit-sharing plan, tend to forget that money has been contributed to those accounts before being subject to income taxation. And conceptually speaking, the way that the tax treatment of those types of accounts work is that the government, in its good graces, basically says to the individual, we'll let you put $1 into this account. Ordinarily, you would owe us 30 or 40 cents on that dollar in terms of income tax, but we're going to let you contribute to that account before paying tax. So essentially, we're going to allow you to put the full dollar into that account. We're going to allow you to invest it on a tax-deferred basis, and then when you pull the money out, we're going to then recover the taxes that you owe us at that point based on whatever your effective tax rate is at the point the money comes out of the plan, and based on the amount that you pull out at that point as well. So conceptually speaking, what that amounts to essentially is a tax loan from the government, where they say, you don't owe us that 30 or 40 cents on the dollar now, go ahead and keep it, and you can just pay us later based on the total value in the account and how much you're taking out and what your effective tax rate is at that point. So one way to think of distributions, the impact of distributions from those types of accounts is that they are subject to a tax lien, or in other words, the account is subject to a deferred tax liability that essentially is repaid to the government when the money comes out of the plan. And at some point, the government forces the individual to start taking money out once they reach the age of required minimum distributions. So it's very important to keep in mind when thinking of monies that have been accumulated inside of a qualified plan and how that may be accounted for on an individual's balance sheet or within an individual's overall long-term financial planning, that there is a deferred tax liability subject to that plan, and that tax liability does have to be repaid at some point down the road. And that really brings up the next question, which is how much is a qualified plan asset really worth on a present after-tax value basis? So here's just a real simple example to help demonstrate the potential costs of taking money from this type of account. So if you have $1 million that has been accumulated inside of a qualified plan, if you were to take that $1 million out, or if it were to be liquidated for whatever reason, and if that individual's effective income tax rate were 40%, then that means that on a present after-tax value basis, that $1 million is really only worth about $600,000. If that is the effective tax rate in effect, or that is applicable to that individual at the point of distribution. And so that's really the kind of the after-tax value to which the individual would have access or be able to use for themselves during retirement, because they have to repay that quote-unquote tax loan that the government gave them initially to allow them to invest on a tax-deferred basis. And if the individual is wealthy enough to also be fortunate enough to be subject to estate taxes, or I should say their estate be subject to estate taxes when they pass away, then based on current estate tax rates, if this plan were fully subject to estate taxes, then you'd have to take another 40% off of that number, and that would be the net after-tax present value of the asset from an inheritance standpoint, because the beneficiaries would have to pay income tax on any distributions from the qualified account, and then the estate would also have to pay estate taxes at the point of death as well. So really, from a wealth transfer perspective, the total potential expense ratio, if you will, or loss ratio, as the page here calls it, if an individual accumulates money inside of a qualified plan and then dies with that asset in their estate, could potentially be up to 64% at the highest federal income and estate tax brackets, and that's not even accounting for any state level taxation, either for income taxes or state estate taxes, depending on the state in which the individual resides. So qualified plans are very effective for accumulating wealth because money can be contributed before being subject to income taxation. Any earnings inside the account can grow tax deferred, but when you go to then pull money out of the account, that's where that tax challenge, if you will, can really impact an individual in terms of how much after-tax spendable cash flow or after-tax wealth is available for themselves or for their beneficiaries. So, as I mentioned earlier, the income tax expense when you pull money out of a qualified account is really based on what your effective tax rate is at the point that the money is distributed from the qualified plan. Qualified plans generally work most effectively when you contribute money to the account when you're in a higher tax bracket, and then you take money out of the account when you're in a lower tax bracket. And so for individuals that have accumulated a decent amount of wealth inside these accounts, the big question is, what will future tax rates be, or what will their future effective tax rate be based on their tax bracket and what actual tax rates are based on tax law at any given point in time be at any point in the future when money is distributed from these accounts. And to address that question, it's sometimes helpful to look backwards in order to get a good sense for what the future may hold, basically. And I'm pretty sure that for any of you on the call here who either are a high net worth or high income individual or advise those types of individuals, you're probably not feeling much sympathy for yourselves or for your clients from our gracious politicians in Washington, D.C. these days. Although tax rates were just reduced with the most recent iteration of tax reform that went into effect last year, the big question is what will tax rates be in the future? And I'm pretty sure that most high net worth and high individuals are not really going to bet much money on tax rates staying low or going down even further down the road. So the issue associated with that is that if tax rates do go up again in the future, which they're actually scheduled to do on January 1, 2026, when the individual tax provisions of the Tax Cuts and Jobs Act that just went into effect last year are set to expire absent any future action from or extension from Congress. And given the political gridlock in Washington, D.C. these days, again, I'm pretty sure most individuals are not betting on there being any type of compromise to keep taxes low thereafter. And so I think most individuals just intuitively know that we're in a pretty low tax environment right now, especially when you look at where we are in terms of top federal ordinary income and capital gains tax rates as portrayed here on the page. Are where we are now as far as those are concerned relative to where they were historically and where they're likely to go in the future given all the deficit problems at the federal level, the gridlock, et cetera. So the additional problem that can pose for the types of assets that we're talking about here is that if tax rates do go up in the future, then that could unilaterally increase the individual's effective tax rate, which could unilaterally increase that deferred tax liability to which their plan is subject and which they basically owe back to the government when money comes out of that plan. So if taxes go up, long story short, that could make these types of plans even less efficient from a distribution perspective, either during life or upon death. Now, most of the advice out there that is given by financial advisors regarding qualified plans typically revolves around how to maximize your tax-deferred contributions to the plan. In other words, how to stuff as much money into the plan before tax as possible, and then how to invest the money once it's there. There's very little advice out there being given to individuals with monies in these plans on how to get the money out of the plan without getting killed in taxes. And that's really where the QLS program here, the Qualified Leverage Strategy, as we call it, really kind of picks up, if you will. So it can really help to optimize and add some efficiency to the back end stage of an individual's retirement planning, where they're now ready to start taking money out of these plans. And we can do so by repositioning the dollars a little bit more efficiently in anticipation of that, to create some tax and some cost efficiencies, as you'll see here throughout the rest of the presentation. And so what we're really going to talk about now is how the QLS can very efficiently address that primary tax challenge, which is eliminating or at least reducing the income tax burden on a portion of the individual's qualified retirement plan assets that are allocated to the strategy, and then also increasing the amount of, as a result, the after-tax wealth available for them and or for their beneficiaries. Okay, so now that we've talked about the problem and the challenges, let's talk now about the solution. So what I'm going to do first is walk you through kind of a step-by-step. There's really only a couple of steps here that are involved in order to position the dollars in order to accomplish that tax efficiency. And it's going to be a strategy that's going to use a permanent cash value life insurance policy, and you'll see the purpose for that here in just a second. And so after we walk through these first initial steps to show how the dollars are kind of positioned in order to be a little bit more efficient on the back end for distribution purposes, we'll then show you the long-term projections of doing it versus not doing it, and the potential financial advantages based on projections that could be realized with the strategy versus without. So the first step in the process here is we have to make sure that the money inside of this qualified account is positioned inside of a proper type of qualified account that allows for us to, or at least the individual, to allocate monies inside their account to pay for life insurance premiums on a policy that's owned by the qualified plan. So it's going to involve, as you'll see here on the next slide, the purchase of life insurance inside the qualified plan using monies in the participant's account. But before we get there, we have to make sure that the money is inside of a profit-sharing plan specifically that is structured with the right language to allow for the purchase of life insurance inside the participant's account and funded with monies in their account. So this initial step here can sometimes involve a lot of planning in and of itself, because if the individual does not have a profit sharing plan, but they have qualified dollars, for example, maybe in a rollover IRA or otherwise, then they have to have the right facts and circumstances in order to justify setting up a plan, which means that they have to have either a trade or a business or some type of business entity. And if they don't have one of those already, then that has to be established anew, and that obviously has some tax and legal considerations associated with it. So all of those considerations are really beyond the scope of our conversation today, but just know that this initial step in the process is the most critical from a planning perspective, because we cannot cut any corners when it comes to setting up business entities entities to sponsor a profit-sharing plan. And we have to make sure the profit-sharing plan is, administered properly and set up appropriately, and all of that good stuff to avoid some adverse tax and legal consequences that can result if that's not done properly. So let's just assume that all of that is out of the way. We have the money inside of a profit-sharing plan that is structured properly to allow for the purchase of life insurance inside of the profit-sharing plan. The next step then is going to be to use monies inside of the individual's account to pay for life insurance premiums on the policy that's owned inside their account. So the policy is going to be applied for and owned by the profit sharing plan on the individual's life, and it's going to be a plan asset basically within the participant's account, funded by monies within their account. And the monies that can be used to fund the premiums for the policy are subject to certain limitations in terms of dollar amount or percentages, unless the money is aged or seasoned money, as it's called, which is money that's at least 2 years old, or any money for the participant that's been for a participant that has been in the plan for at least 5 years. So there's some timing considerations there regarding the type of or the amount of dollars that can be used. But we're just going to assume, for the sake of this example, again, that we're working with money that can be fully eligible for this strategy here. So assuming that's the case, how we typically design these programs is for the premiums to be funded usually over a period of 4 or 5 years, depending on the individual situation and their age and their goals and all that good stuff. So the policy is going to be a permanent cash value policy. And the cash value is going to grow while it's in the plan. There's going to be a death benefit component as well. So if the individual dies while the policy is in the plan, there will be some additional cash that's injected into their account by way of the death benefit, basically. But eventually, we want to get the policy out of the plan, because when a life insurance policy is owned personally or in a normal ownership environment, I'll just call it, the cash value grows tax deferred and can be accessed income tax free by the individual, and the death benefit can also be fully received by the individual's beneficiary without having to pay income tax on it, or basically being able to be received by the beneficiary without being subject to taxation. So we want to get the policy out of the plan so that it can enjoy all of those normal tax-free benefits that are created by way of statute. So the tax benefits of life insurance are codified and are contained right within the tax code itself. So we want to take advantage of those to what extent we can. But in order to do that, we got to get the policy out of the plan. And that's going to bring up a couple of additional reasons why life insurance can be very effective for this strategy. In addition to, as you'll see here in a couple of slides, the long-term cost efficiency of the policy from a cash accumulation and distribution perspective when designed properly, as well as, or in addition to that, the underlying pricing dynamics of the policy make it very efficient for income tax planning purposes when we go to distribute the policy from the plan. With permanent cash value life insurance, there's typically additional charges that are priced into the policy up front within the first 5 to 10 years usually. And those charges are allowed to be taken into account for the purposes of calculating the fair market value of the policy for income tax purposes if the policy is transferred from the plan. And so what that can amount to in the early years is a pseudo valuation discount effect, if you will, where money goes into the plan that otherwise would have grown in a tax-deferred environment, and when that policy then goes to be distributed from the plan, for income tax purposes, we have to recognize an amount of income equal to the fair market value of the policy because it's a taxable distribution from the plan. And in doing so, when we calculate the fair market value using the formulas that are provided by the IRS, we can account for those charges that have been paid early on, which go to fund the death benefit. And then a lot of those early charges eventually go away as a result of this front-loading dynamic that many carriers use when they price these life insurance policies. And so for income tax purposes, the fair market value of the policy can sometimes be less than the total premiums that have been paid over the first few years, which from the standpoint of the strategy can be very tax efficient because we can essentially strip dollars out of the plan that have been paid into the policy and realize a valuation discount effect for income tax purposes. And what we can see here is on the far right-hand column there, that's the assumed fair market value of the policy based on the projected values, and the formula that is used to value the policy as provided by the IRS in a revenue procedure from several years ago. So $1 million went into the plan, and over 5 years, that $1 million otherwise would have grown based on the earnings in the plan, but when the policy comes out here, they only have to recognize $920,000 of ordinary income with respect to that distribution of the policy. So that can create some tax efficiencies basically when getting the money out of the plan. And then after the policy's out of the plan, it then enjoys all of its normal tax-free characteristics. So that the next step here is then going to be transferring the policy to the participant. And the policy can be transferred from the plan in one of two ways. One way is they can just make a distribution of the policy as shown here, and the individual recognizes the fair market value of the policy as ordinary income since it's a distribution from the qualified plan. Alternatively, we're not going to talk about this today, but alternatively, the individual could also buy the policy from the plan by essentially swapping cash for the policy itself, or in other words, reimbursing the plan for the fair market value so that it's considered a sale and not a distribution, which amounts to essentially them just swapping money from their right pocket to their left pocket. But in this case here, what we're going to show is just a simple scenario where the individual distributes the policy from the qualified plan to themselves from the profit sharing plan, that is, and that's going to amount to $920,000 of ordinary income recognition, on which, assuming a 40% tax rate, $369,000 of ordinary income tax would then be due. So that now brings up a couple of things. One is now the policy is outside the plan, and the policy enjoys all of its normal tax-free benefits that we talked about earlier: tax-free growth, tax-free access to the cash value, and a tax-free death benefit. But the question then becomes, how do we pay that tax liability in order to minimize or eliminate the individual's out-of-pocket costs for essentially repositioning those dollars into a more tax-efficient account? So think about a couple of things there. When an individual recognizes income during a calendar year, if they're a calendar year taxpayer, usually the tax on that income is due by April 15th of the following year if they file their taxes on a calendar year basis, like most normal taxpayers do. So then the question becomes, how do we come up with the money to pay that $369,000 tax liability here in this case? Well, they could certainly write a check with other assets if they wanted to, although most individuals probably don't want to write a big check to the government all in one year just to get some life insurance. And so an alternative source of funds for paying that tax can actually come from the policy itself, taking advantage of some of the very favorable ways in which value from within the policy can be accessed by the client, specifically using what's called a policy loan, or just taking a loan from the carrier, which is secured by the policy. And in doing so, it can allow the individual to reposition those qualified dollars that were inside the profit sharing plan that were then funded that were used to fund the premiums inside the policy into a more tax efficient environment after the policy is distributed from the plan, and the tax on that distribution can be paid for using the policy itself by just taking a loan from the carrier. And a lot of life insurance policies available today have very attractive and efficient loan terms and mechanics that allow the individual to essentially take a loan against the policy from the carrier without having to forego interest earnings on the cash value as a result of doing so. So essentially, the individual here can take a loan from the carrier and still allow the full account value to grow inside the policy that can generate tax-free interest over the long term that can be and tax-free growth that can be accessed later on down the road by the individual, as well as generate a tax-free death benefit. And the loan itself can just be repaid with the future death benefit of the policy. Now, the individual could make payments on the loan if they wanted to, just like a traditional loan arrangement, but in many cases, the policy owner will simply just allow for the future death benefit to pay off that tax loan. So what this has basically accomplished so far from an overall movement of money perspective is we had $1 million that was inside the profit sharing plan. We systematically allocated those dollars into the life insurance policy as premiums over a period of 5 years. And that policy was distributed from the plan, essentially moving that $1 million out of the plan. Now it's working inside of a tax-free life insurance policy outside the plan, and the tax on that distribution, which was only $369,000, was paid for by the policy itself using a policy loan mechanism that essentially allows them to use money from the policy while still making money within the policy at the same time, and the future loan proceeds are just repaid by the future death benefit. So now that policy is outside the plan, and any additional cash value in excess of that loan that accrues long term can be accessed by the individual on a tax-free basis. So we've essentially just moved money from the taxable environment into the tax-free environment, and in this case for no additional out-of-pocket cost to the client, because the policy was the source of the funds through that policy loan to pay the tax. Okay, so that's basically how it works and kind of the steps that are involved in order to reposition the dollars over the first few years. Next, what we're going to show is how does this look over the long term based on reasonable assumptions for investment returns and taxes and things like that. So in other words, if this individual in the future were to start drawing down on these assets to supplement their retirement income, how would it compare from the perspective of doing the QLS strategy versus just keeping the money inside of the profit sharing plan? So now we're going to get into some detailed projections and some detailed financial projections here. And this is a cash flows comparison. So this basically just shows the timing of any of the assumed investments and or expenditures with what we call the status quo, which is just leaving the money inside the plan and staying the course as is, versus the QLS, which is repositioning the dollars as we just talked about. And so this doesn't show the actual accumulation of the account values. I'm going to show you that here on the next page. This just shows basically money going in, being invested, money coming out for income, basically. So under columns 4, 5, and 6 there, under the status quo, what that assumes is that $1 million is invested inside the profit sharing plan. It grows at a 6% gross rate of return, and I'll summarize the assumptions that we make here on the next page. Grows at a 6% gross rate of return. And then when the individual reaches age 70, we're going to assume they start pulling money out of the plan just on a systematically equal basis to fully liquidate the plan over a period of 30 years, I think, from there up to age 100. And the after-tax income that can be generated from that $1 million invested inside the profit sharing plan in the first year, based on the assumptions, is $77,000 per year. So that's after any income taxes have been paid off of the distributions. That's the after-tax, basically, potential cash flow based on the assumptions that we're making here for the plan. And then the QLS columns there, columns 7 through 14, basically, that shows the $1 million, the same $1 million being invested inside the plan in the first year. Column 8 shows just conceptually the $200,000 being allocated over the premiums. Columns 10 and 11 then basically show that tax liability that's generated as a result of distributing the policy from the plan and the policy loan proceeds that are used to fund that tax liability, so that there's no out-of-pocket cost to the individual for removing the policy from the plan. And then in column 14 shows the total potential after-tax income that can be generated as a result of taking distributions from the cash value in the form of additional policy loans in the future, plus any modest amount of after-tax income generated by any residual profit-sharing plan dollars left within the QLS program after the policy has been distributed. But that's predominantly going to be comprised of the income coming off of the policy through additional policy loans down the road. So we can, just from an income standpoint, generate on a projected basis, based on these assumptions, a pretty healthy increase in the after-tax spendable cash flow for the individual, and that's really a primary result of the cost efficiency of the policy long-term when structured properly, and the ability to take money out tax-free relative to the highly taxable nature of the qualified plan asset long-term and the taxes that would generate on distribution. So in other words, based on these projections and if structured properly, the long-term policy charges that are deducted from the cash value inside the policy can actually be a lot cheaper than the taxes that would otherwise be paid on the qualified plan distributions down the road. So here's visually what the two options look like in terms of the projected income and account values and wealth transfer values. So the top charts, the bar chart and the area chart there on the right-hand side at the top, those top two charts represent basically what we just looked at, which is a comparison of the total after-tax spendable cash flow that can be generated with the status quo, which is leaving the money in the plan, versus the QLS, which is repositioning the dollars and using a life insurance mechanism in order to better position those dollars for distributions down the road. And based on these projections, which are all, again, based on a 6% gross rate of return, so a very reasonable rate of return from a long-term investment perspective, and based on a 40% tax rate, which may be more or less, obviously, depending on what their effective tax rate is in the future and what actual tax rates are. The QLS program here can generate an increase of about 70% in after-tax spendable cash flow. Now, again, these are all based on projections, and it could be better or worse, and it's all hypothetical, but just for conceptual sake, to demonstrate how this could work, we just use some static assumptions here to keep it simple. The middle set of charts shows any account values net of, with each strategy, net of any deferred tax liability on any remaining profit-sharing plan assets within either strategy. So in other words, with the QLS, or excuse me, with the status quo, those blue bars would represent any remaining profit-sharing plan dollars net of whatever remaining deferred tax liability is due on those profit-sharing plan dollars. So in other words, what's the remaining after-tax value of the profit-sharing plan long-term after the income has been distributed. And with the QLS program, that would basically be the tax-free cash value that's remaining inside the policy, plus any modest remaining profit-sharing plan dollars after tax, which is not much here in this case, since we reposition most of the dollars over into the policy over the first few years. So another way to think of it is that the middle set of charts is the investable net worth that's remaining net of any deferred tax liability on any remaining profit sharing plan dollars. And then the last set of charts at the bottom where it says wealth transfer after income taxes, that's basically just adding in the value of the death benefit of the policy that's remaining into the QLS program, and showing what would be available for the individual's beneficiaries on a present after-tax value basis at the point of death. So pretty substantial potential increase in supplemental retirement income, and a pretty substantial increase in the amount of wealth that can be left as a legacy to their next generation. So in other words, it can be a very effective and very efficient strategy long-term for the individual during their life and for their beneficiaries upon death. And it can also be a very effective strategy for the beneficiaries from an inheritance standpoint over the beneficiary's lifetime. So it's obviously better to inherit tax-free money than it is to inherit taxable money, and it's obviously better to inherit more than less. And so with the QLS program, we can not only create more wealth for the individual during their lifetime, but also more wealth for the beneficiary over the beneficiary's lifetime after the first generation passes away. So what this set of charts here shows is what is the total potential income that can be generated for the next generation for their beneficiary over their lifetime from the point of inheritance. So on the prior page, we assumed that the individual is going to die at year 35, which is their age 90. That's that yellow highlighted bar there on the charts on the right-hand side. And so if we assume that they die at year 35, at which point their oldest beneficiary is assumed to be age 60. So if we assume the current age of their oldest beneficiary is 25, they die in 35 years, they're 60 years old at that point when they are assumed to inherit the money from these particular accounts in the analysis here. And then we assume that they take distributions over their life expectancy based on the inherited IRA distribution tables, which require beneficiaries to take minimum distributions over their life expectancy, basically. We can see that over that time frame, based on the same assumptions for investment rates of return, that there's a pretty substantial increase in the overall income potential for the next generation, in addition to obviously generating more potential wealth for the original account owner during their lifetime. So more money for the individual during their life, more money for their beneficiaries over their lifetime as well. So it can be a very effective legacy vehicle for wealth transfer planning in addition to retirement planning. So, and then we don't have time to really get into any of this today, but there's a lot of different ways in which we can implement the strategy and incorporate it into the individual's overall financial and estate planning. For example, we can add some Roth conversion type strategies on the back end that can create even more tax-free money for the individual for a very minimal or potentially zero out-of-pocket cost to the individual. There's also ways in which we can integrate this into their estate plan so that if they were to set up an irrevocable trust for wealth transfer planning purposes, their trust could be the entity that actually buys the policy from the plan, so the policy gets immediately outside of their estate for estate tax purposes. Again, beyond the scope of our discussion today, but just know that there's a lot of different ways in which we can implement the strategy to accomplish various financial and estate planning objectives. So very flexible and very versatile for the client as far as the types of needs and goals that it can address. But as we mentioned earlier, it's not for everyone. You know, you really have to have an individual, or you have to be an individual that has the right facts and circumstances up front in order to position the dollars properly so that the rest of the steps and the rest of the benefits that we talk about can fall into place. So a lot of consideration up front from a planning perspective to address, but assuming that the individual has the right facts and circumstances, a lot of potential financial benefits that this could yield long term. So that's going to wrap up our discussion here. I'll go ahead and turn it back over to Josh for any questions or comments that came up.
Great, thanks a lot, Michael. Just a reminder, so we're going to take a couple minutes, compile the questions that all of you have. You can either submit them via the chat box on the right, or raise your hand and we will call on you. So just give it a couple minutes or a couple seconds to compile those, and then I'll turn it over to Matt.
Yeah, so we had a few questions come in. So first one is, what is the impact of this strategy if income tax rates rise in the future?
Yep, that's a great question. I've covered that briefly earlier, but I think it's always good to reinforce that because that is a really important consideration when planning for distributions from qualified assets. Because if tax rates go up in the future, then that's going to unilaterally increase that deferred tax liability to which the plan is subject, which then basically means there's less after-tax wealth available from the qualified plan itself when distributions are made, because there's a higher tax liability on those qualified distributions. So in other words, to bottom line it, if tax rates go up in the future, that means that the strategy is even more effective because it's better to have money in tax-free accounts that can be accessed without paying tax than it is to have money in taxable accounts that are subject to potentially higher tax rates.
Okay, next one is, does this strategy work if I have a Roth?
It unfortunately does not work if you have a Roth IRA with respect to using the dollars inside the Roth IRA or the Roth account. Since the money's already in a tax-free account, just keep the money there, keep investing it. But where it could work is that if you have money that's in another in a separate profit-sharing plan or qualified account, we could reposition those dollars, as we talked about here, to create some additional tax-free accounts, essentially. But unfortunately, Roth accounts and Roth IRAs cannot buy life insurance, so there's no way that we can really use the money there, nor would it really be necessary since the money's already in a tax-free environment.
Another one is, what is the minimum amount of assets in a profit-sharing plan that is necessary to make this strategy worthwhile? And would I use the entire value or just part of it?
That's a great question. And that's something we spend a lot of time talking about with the client and their tax and legal advisors up front. Because again, there's a lot of I's that need to be dotted and T's that need to be crossed in order to, make sure the planning and the overall structure, is designed to create the type of outcome that we want. And what I typically will advise individuals is that there's so whether we use $100,000 or $1 million or $10 million, whatever, the math all still works. But it's really more about, does the incremental benefit you're getting by doing it versus not doing it relative to your overall estate and net worth and any additional planning that needs to be done up front. So sometimes there may need to be some business entity planning or some trust planning or what have you. And unless we're dealing with dollar amounts that are just large enough to generate enough savings long term to justify, the expense and the time investment up front to do the right planning and get everything situated properly, then it may or may not be worth it to the individual. But just from a financial perspective, the math works. It's all proportional either way. What I will typically just give as a rule of thumb is, in order to make sure we have the right individual that's a good prospect good candidate for the strategy, and that they have enough dollars to work with in order to generate, a meaningful delta, if you will, long term, that, we're typically looking at about $500,000 or more inside of a qualified account of some sort to work with. But we've done it with less and we've done it with a lot more. Just depends on the situation.
So another one is, how could I use this strategy if I already have a second to die life insurance policy in an irrevocable trust?
Well, that's an interesting question. So if you have a policy that's already inside of a trust, there's really no way to efficiently use that policy in the way that we talked about here in the presentation. However, if there's money that's currently residing inside of an IRA or a qualified plan inside of your estate, then we can go through the steps that we talked about here and maybe create some additional life insurance coverage for you long term that can be used for either the purpose, like what was shown in the example here, for supporting retirement income, or for wealth transfer planning, just depending on how the policy can be designed and how the overall planning can be designed. One interesting way is that this could be maybe combined with that type of situation is that if there's ongoing premium requirements that that are due on that survivorship life insurance policy inside of the trust that may require ongoing gifts to the trust or may require, ongoing, allocation of income from the trust to fund the premiums. We could do the QLS program, the QLS strategy here, and once this policy, so let me back up for a second. That existing irrevocable trust, if it's properly structured, could eventually buy the life insurance policy from the qualified plan that was funded with the QLS dollars, so that policy goes into that trust as well, and then there's additional cash in that new policy that was funded with the QLS dollars inside the trust that could maybe help fund ongoing premiums with that existing survivorship life insurance policy to help mitigate or minimize any additional need to make additional gifts to the trust otherwise. So, or just be used to create additional wealth outside of your estate if you like that aspect of estate planning and how life insurance can contribute to that.
All right, two more. And then, so what type of life insurance policy would be purchased in the qualified plan?
Yep, typically we use what's called an indexed universal life insurance policy that credits interest to the cash value in a manner that's linked to an external stock market index like the S&P 500, so that it provides solid potential for growth, but that can never earn a negative rate of return as a result of market-based losses with respect to the crediting rate. So it's a very efficient means by which to grow wealth in a way that provides attractive upside potential, but also good downside protection. And it also, those types of policies also have some very efficient loan mechanics that, as I mentioned briefly earlier, allow you to take a loan from the carrier and still earn interest on the full account value. So that's just to keep it short and sweet. It's what's referred to as an indexed universal life policy. Generally is what we found to be the most efficient.
All right, sorry, two more after this. So it shows patent pending at the bottom. Is this IRS proof?
Well, it's not. I mean, the IRS doesn't approve of anything per se, but one of the nice things about the strategy is that it's not dependent upon gray areas of the tax code or gray areas of the regulations. So the ability to purchase life insurance inside of a qualified plan is established law, basically, that is supported by regulations that have been issued that deal with the tax treatment of life insurance that's purchased inside of qualified plans. And there's very specific rules regarding how much of the plan dollars can be allocated towards premiums. So there's no gray area with respect to buying life insurance inside of a qualified plan. There's also no gray area with respect to, as long as it's structured properly, I should say, with respect to distributing the policy from the plan or buying the policy from the plan, if that's alternatively used as the means by which to get the policy out. So basically, the underlying economics and tax aspects of the strategy are all fully supported by established statutes, regulations, revenue procedures, et cetera. The patent pending thing actually is so the individual who created this program has created software alongside of it to do all of the complicated financial modeling, and also has created a very specific sequence of strategies that can be used in order to maximize the tax efficiencies and create as much tax-free wealth as possible. And it's really kind of that process and that software that is currently patent pending.
And last question is, what is the ideal age range for the strategy? Is there an advantage for someone younger than 50 or older than 70?
Great question. Yeah, that comes up a lot. So there's really no specific age range where it does work or doesn't work per se. It really depends on the individual's goals with respect to whether or not they want to maximize retirement income potential from the strategy, or whether or not they want to maximize the wealth transfer value of the strategy for the next generation. But generally speaking, if the goal is to maximize retirement income off of the assets, then we're typically looking at someone maybe up to in their mid to upper 60s. And some of that might depend on their desired time horizon within which they'd like to begin accessing the money. But generally, mid to upper 60s or less is kind of the limit for a retirement income focused design. And individuals who are younger than age 60, one of the considerations there is that if if we're going to do the strategy in the form that it was presented here, where we just distribute the policy as a taxable distribution from the qualified plan, then we have to be cognizant of the potential 10% penalty that can apply before age 59 and a half. So in some cases, like if an individual is 52 years old, for example, instead of distributing the policy after 5 years, we may wait a few more years until they turn 59 and a half or 60 and then distribute the policy at that point to avoid the 10% penalty. For wealth transfer purposes, it can work very effectively all the way up to the mid to upper 70s, just depending on their insurability and their overall financial situation. We've even had some individuals who are over the age of 80 where the financial benefit of doing it versus not doing it was more than sufficient enough to justify it. But in that case, for extremely older individuals above age 80, we're typically looking at much more wealthy people that have estate tax, that have an estate tax exposure because their net worth is high enough to generate a federal estate tax, where repositioning the policy in a manner that gets it out of the estate, as I've briefly alluded to a couple times, creates not only income tax leverage but also estate tax leverage. So it just creates a bigger delta that is more helpful in justifying it financially. But really, for traditional wealth transfer purposes, regardless of whether there's an estate tax exposure, probably up to the mid to upper 70s, I would say is a comfortable age range.
Okay, so that wraps it up. Michael, again, thank you, and thanks you to everyone who joined. There will be a replay that we will send out that those of you on the call absolutely can listen to or forward on to anyone you think would be interested. And you can always respond to us if you have additional questions or want to speak further about the strategy. With that, we'll wrap it up, and thank you all very much.
Thank you. Have a nice day.